Hello, this is Melissa, your insurance exam queen, and we are here on this channel to help make sure you can pass your insurance exam with ease and confidence.
Now we're going to go on to another policy. This is a whole different item. It's called a whole life policy, and it structures differently than term. It still provides a death benefit, okay? What they do in whole life is they give you a level premium, means you're never going to get a rate raise for your whole life. Whatever you start paying at, you will pay that same premium even when you're 85, 90, and 100. That's still the same rate. Now, if it was term insurance, you would say to yourself, a term to 100, yes, that's going to start pretty high, right?
Yeah.
Because the insurance company is locking themselves in for the rest of your life. And that's true. Whole life does start off higher, but it never goes up. Because it does not increase, you can keep it for your whole life. Because if you can afford it today, you're probably going to be able to afford it for the rest of your life. So its name, whole life, really means it's designed for you to keep for your whole life. Now, different than term, this policy is what we would call permanent, because you can keep it. It's not going to expire on you. It has cash value. I'm going to say this a couple different ways. Cash value is a living benefit. It's money you can get at while you're alive. So different than term, you don't have to die to get money out of a whole life. You can get money out of a whole life while you're alive. That cash value, this is important. I'm going to say it later on to emphasize it. The cash value in a whole life is equal to the death benefit when you are 100. All right, let me just say that in another way. We're going to pick on Ingrid. She's a young girl. She's probably 17 years old or something. she buys a $100,000 policy. And then she says, Peter, I'm interested in this cash value. I can get at that while I'm alive. How much is it going to be? Well, I know for a fact that when you're 100, your $100,000 policy is going to have cash value of 100,000. Your cash value equals the death benefit at age 100. That doesn't change. It's guaranteed in the whole life. Of all the policies we're going to study, whole life has the most guarantees for the policyholder. We guarantee your rate for the rest of your life. We guarantee the death benefit, and we guarantee your cash value will equal the death benefit when you're 100. Those are all legally guaranteed by the insurance company.
Okay, question. So am I making it too crazy, weird? So cash value, one is what you will get when you are at 100. And then, but it's also for when you're alive. Face value is just death benefit. Am I right in that?
Exactly right. Face value, death benefit are the same. It's what goes to the undertaker. It's when you die.
Yeah.
Now, the cash value starts off very, very low in a whole life policy, but it increases over the years. And it grows and it grows and it grows. And that's money that you can take out if you need it. And it will be worth the death benefit when you're 100.
Gotcha.
But that's a living benefit. And we'll talk about how those get the money out and everything.
It took me a long time to finally get that into my head because nobody ever told me that face value had anything to do with death benefit. You know, these are the questions that kind of mix me up in my brain. Yeah.
Well, you're just taking the wrong class. You're the wrong teacher. No,
no, I got the wrong brain.
No, tell it, Peter, tell it.
Question. Whoops. Term insurance is different than whole life. Number one, it provides a tax-free death benefit. Two, it requires medical questions. Three, it does not have policy loans. Or four, the owner chooses the beneficiary. Three of those answers are the same for whole life and term. Only one tells you the difference. Can you find it?
Number three.
Number three.
Number three is what they're saying. No, oops. Number three is correct.
Oh, yay, good.
You can't get any money
I'm
living benefit.
excited when I get one right, yeah.
If you
Take you
don't know,
with me, Peter, to take my test.
yeah,
Take
going past,
mine.
going past the test, you can't get cash value out of a term policy. Okay. Now, those other three are true of any life insurance policy. The death benefit's income tax free. I hope you know that. But if you
Yes.
don't remember that, that's take home pay for the beneficiary. It requires medical questions. I mean, we don't just give these policy out to somebody who walks in hospice care. You know, that person's not getting a policy. But the owner can choose the beneficiary. That's whether it's term or whole life. Okay. Let's go on to the next question. Whole life premium payments. Now, this one is one that we just got to go slow on to make sure you get this. The way I pay for my whole life doesn't change the nature of the whole life. Okay. I can pay for it lots of ways. You know, when you buy an item at the store, you can pay for it layaway, you can put it on your credit card, you can do cash. It doesn't change the product you're buying. And the same thing here, the way you pay for it doesn't change the whole life. Some people say, if I pay for it a different way, I get a different policy. No, you get the same policy. The most understandable way is what we talked about, level premium for life. And they often call that straight life. You pay the same premium until you die or turn 100. That's easy enough to know. But you know, you can pay this policy off early. And we call that a limited pay life. So if you say to your agent, I don't want to pay after I retire, so I'd like to give you enough money that when I hit age 65, this policy's paid for. I don't have to make any more payments. You can do that. We call that a limited pay life. It's kind of like taking your 30-year mortgage to a 15-year mortgage. You can do it, but if I want to go to a 15-year mortgage from my 30, what happens to my monthly payment?
Goes up.
Exactly. And if you want to pay your policy off earlier, you got to pay us more money so that we'll allow you to stop at a date that you want.
Yeah.
That's a limited pay life, but it doesn't change the whole life. The cash value still equals the death benefit when?
100.
100. That's a test question that everybody likes to miss. They say, oh, I only pay till I'm 65, must be the cash value equals a death benefit at 65. So it doesn't change it. Or if you won the lottery or something like that, and you say, what, I just want to give you one chunk of money and never pay for this again. That's called a single pay life. The insurance company, they got the smartest mathematicians in the world. They calculate it all out and say, yeah, give us 30, 40,000 right there. And you never have to pay again. But you still have a whole life whose cash value is going to equal death benefit at 100, no matter how you pay for it. So you're going to get questions on straight life, limited pay life, single pay life. They aren't different policies. They're just paying for a whole life different ways. So let's talk about this. Straight life, you make the same payment for life. Limited pay life, you increase your starting premium so you can pay it off early. For example, these are examples of a limited pay life. You could have a 20 pay life. So after 20 years, you don't pay anymore. You can have a 40 pay life. You can have what we call a life to 65. When you hit it 65, you've made all your payments. And you can, it's like Build-A-Bear. You can go and build it any way you want, but it doesn't change your policy, right? You're just like prepaying your whole life so you can stop at some date. The least expensive for your cash flow is to do the first one, to start at a certain level and make that payments and know I'm going to pay that until I die. Okay. Or you can get fancier, but some people think when I buy a limited pay life or a single pay life, I'm getting a different kind of insurance. No, you're not. You're getting a whole life. It's just how you pay for it. So whole life premium payments, no matter, I'm making a point, which I've been making for 3 slides. No matter how you pay for it, the cash value always equals the death benefit at age 100. So I would say this in summary, only because I love you. 2 things to remember about a whole life. We structure it so that you can pay the same payment forever. It won't go up. And the cash value is going to equal the death benefit at 100. That's how we start with a whole life policy. That's a completely different way to get a death benefit paid off than term insurance, where we're just going to, just think from an insurance company's point of view. A 25-year-old comes by and buys to buy a 10-year term. The odds are we're going to pay very few of those claims. There are young people who died, but compared to how many exist, they're not dying off like my high school class. Okay. But I mean, so when you get older, it's more frequent. And so the insurance company doesn't have to charge a lot if they're only on the limb for 10 years on very young people.